Greetings, everyone. I'm Cathie Wood, CEO and CIO of ARK Invest, and as usual, I'm going to talk about fiscal policy, monetary policy, economic indicators, market indicators, and a little bit more about our favorite topic, innovation. It's really interesting to me over my career, which now spans well over 40 years. I started when I was very young in college, but it seems like in March, the month of March, especially around this time, specifically this week, the market tends to go through cathartic moments, either coming out of a bear market or perhaps relapsing into a bear market. And here we are again. And often the trigger is something financial, something in the banking system. So here we are again. And I think this time, just to cut to the quick here, I do believe that with the banking failures that we are seeing, Silvergate Bank, Silicon Valley Bank, and there may be a few more regionals, but we do not think this is a systemic banking problem. We do think it will cause a different kind of conversation at the Fed. We've been talking for a while about monetary policy and signals that that monetary policy had gone too far in terms of tightening. And I do think bank failures are a wake-up call very often for policymakers generally and the Fed specifically. So we think that's going to be the case this time as well. But before we go to monetary policy, let's start at fiscal policy because we have the Biden budget proposal. And just a couple of things on the spending side. The increase in spending is $2 trillion over 10 years. I know that the Republicans want a cut in spending over 10 years. So right there's a big gulf. There are three areas, though, that the Biden administration is willing to cut spending. The first is the Small Business Administration. Well, small businesses are the biggest job generators. And I think I read somewhere in mulling over this budget that one of the reasons to this is they want to stop employment or slow it down so that the Fed will slow down. That's kind of interesting. The other interesting spending cut is Department of Transportation. I think I've read about 5 train derailments in the last few weeks, and planes at airports at risk of running into each other, lots of reports of those. So I'm not sure that's the best place to cut, but nonetheless, there are a few cuts in the budget. It'll be interesting to see how the negotiations go. These budget proposals are typically a no-go. They're going to change radically. But I did want to give you a sense of the massive tax increases across the board that the Biden administration is proposing to close the budget deficit. For example, the corporate tax going back from 21% to 28%, a tax on share buybacks of corporations going from, well, they're saying 1% to 4%. So a fourfold increase there. Yeah, 40% increase, roughly 40% increase in the corporate tax rate. But even taxes like the Medicare tax for individuals making more than $400,000 a year, they're proposing that go from 3.8% to 5%. Now, that sounds like kind of a small increase, but that's a 30% increase. And we have other examples of a doubling, the tax on foreign earnings going from 10.5% to 21%. That's a doubling. So we have the tax on carried interest, once again showing up. That's nearly a doubling from 20 to 39.6. So a lot of tax increases, including ones that we think would hurt capital formation. Capital gains tax going from 20 to 39.6%, the dividend tax 21 to 39.6%, a net wealth tax being initiated at 25% for individuals making more than $1 million. These are massive tax increases, and taxes have consequences. My mentor and friend, Art Laffer, just published a book with that title, Taxes Have Consequences. And he's been very focused on what taxes do to behavior, and had been predicting for years a migration from California and New York, the tri-state area generally, to Texas and Florida. And of course, and other low or no tax states. His own state of Tennessee, no state income tax. And of course, COVID has accelerated this shift. But I think this tax proposal is going to push it into overdrive. And those parts of the country that are beginning to feel the effects of this migration in the form of deficits much higher than they expected, they're going to find themselves in a much bigger predicament if this kind of tax package goes through. We don't think it will. The negotiations are going to be tough, and it'll be interesting to see if they can come to any agreement on this or on raising the debt limit. My guess is, with the turmoil in the financial markets we're seeing today in recent weeks, they're not going to want to add to the turmoil. Remember, we defaulted on our debt because they couldn't come to an agreement in 2011, and the ratings agencies downgraded our debt. They don't want to go through that again. So we think they will come to an agreement, but it will be hard fought as usual. Okay, on to monetary policy. We've been very focused on the trajectory of M2. So M2, the growth rate peaked in February of 21 at 27%. And we've been suggesting that if there were no changes in Fed policy, that we would see a decline in M2 for the first time since the Great Depression in the 1920s. And here we are. January was the first negative month. February, the actual number is not out yet, but we know that demand deposits, so checking accounts, are down 4% year over year. So that means that all of M2 was probably down somewhere in the 2 to 3% range, probably closer to 3. So now these declines are becoming more serious. And we've been expecting some issues to show up as a result. Another clue that monetary policy is too tight is the yield curve. The yield curve, so the difference between long-term interest rates and short-term interest rates, is inverted, which means long-term interest rates, which are usually higher than short-term interest rates, are actually lower than short-term interest rates. They got to a little more than 100 basis points, or 1 percentage point lower recently. Now, the media is finally picking up on this and talking a lot more about it, trying to figure out what it means. And we've been saying for some time that it means that growth and or inflation are going to disappoint on the low side of expectations within the next year. And I think that the Fed is not paying too much attention to this indicator, because it's looking at backward-looking indicators. So employment and the headline measures of inflation, not the leading indicators. So the leading indicators of inflation are pointing down to deflation, actually. And this idea that we should be using employment, I understand its mandate is to encourage full employment. And we think low inflation is consistent with full employment. But we don't like this idea that because employment's going up, that's a bad thing. It's inflationary. That's the Phillips curve view of the world, which I've discussed on this webinar a few times in the past. But basically it says if employment and output are moving up, then the risk is that inflation will move up as well. The history of the last 40 years, on balance, suggests that is just false. We had inflation and interest rates coming down pretty consistently from the early 1980s until 2020, so 40 years. And during that time, some of the strongest economies with the best employment gains and output gains were in periods when inflation was coming down. And the link there is that when you have strong output growth, you tend to have strong productivity growth as well. And productivity, so output per man hour, enables companies to actually pay higher wages without increasing their prices, or they can increase their margins without increasing their prices. Now, very recently, companies have been doing the opposite. Companies, even like P&G, have been relying on pricing to maintain margins. Why is that? Well, as prices went up, the consumers started pulling back. P&G's volume growth in the fourth quarter was down 6%. That's crazy. That's very unusual for a staples company as well. So basically, the consumer is saying no mas. And I think while many at the Fed and elsewhere think that these higher prices are going to be perpetuated, and we'll get into the wage structure, I think we're seeing quite the opposite. If volumes continue to be hit because the consumers are saying, no, I'm not going to be buying that anymore, well, the hit is going to be to margins. So I think monetary policy narratives have to change a bit here. And they haven't yet. Chairman Powell was out this week in front of Congress, both houses of Congress, sounding very hawkish. Why? Because some of the economic indicators that have come out recently look strong, including initial unemployment insurance claims. They're going down, suggesting employment is doing fine. So we'll get into that in a moment when we talk about economic indicators. But we're beginning to see brewing here a banking crisis. And the question we have to answer, is this going to become systemic like Lehman Brothers in 08 or 09? Or, and we're betting on this latter one here, is this more like 1994 when Orange County went broke, and that created a crisis to which the Fed responded? We think it's much more like 1994 because the setup was similar. In 93, 94, commodity prices had taken off as we were coming out of that recession. It was an S&L-induced recession, so housing. And the Fed was railing against those price increases with higher interest rates. It was a terrible year for growth stocks. And that's how we would characterize 2022. But when Orange County went bust, that was a sign that the Fed had gone too far. And the Fed did change its spots. We believe that the failure of Silvergate Bank and Silicon Valley Bank, which just went, the FDIC put it into receivership today. Both of those are telling us a couple of things. One, that yeah, the Fed has gone pretty far and is causing a lot of banks, not just these, difficulties. And I'll describe how in a moment. So we do agree with those who say, well, Silvergate had a concentration of crypto clients, customers, and Silicon Valley Bank had a high concentration of venture and venture-related customers. And so that's all true. But if you look at what has happened here, it is the deposit outflows that have triggered the problem, the crisis. We know that venture capital is facing a bit of a liquidity squeeze. Fewer deals are being done. There is more risk aversion in the marketplace. And so these companies are having to draw down their deposits. Most bank with Silicon Valley Bank. They're drawing down their deposits because they have to. And there are others perhaps at Silicon Valley Bank who are saying, wait a minute, I'm not being paid anything here at this bank, or not paid very much, so I'm just going to put my money in a money market fund until I need it. A lot of banks are facing that latter risk. If you look at the money center banks, the big banks, they hardly pay anything on deposits, and so money is fleeing to money market funds. Now, that's not going to present a difficulty for the big money center banks. They are extremely well diversified. Most of them have nothing to do with venture, or if they do, it doesn't represent a big percentage of their business. But there are smaller banks out there that are facing some issues. And I'll just say one more thing about the large banks. Because of what happened in 08-09, they have been forced by regulators into capital ratios, which suggest that today they are extremely well capitalized, and they're like Fort Knox, so very safe. So this is no Lehman moment. However, there are small regional banks out there who were not subject to the same kind of capital ratios, and they therefore have been taking business that used to go to the large money center banks, perhaps disproportionately, and moving more into funding venture companies, or they've been moving into commercial real estate. Historically, they've had a big position in residential real estate, as you might imagine. Local banks know their local customers, and so real estate, residential real estate. But now, on average, 25% of their loan book is in commercial real estate. And what we have to watch here is the office part of commercial real estate. Offices are empty now. There's been a lot of building going on, and those new buildings are getting all of the attention, and the older buildings are really the vacancy rates are quite high. So we are seeing what is called strategic defaults, and what that means is that the borrowers are going back to the lenders, like these regional banks, and saying, our vacancy rates have gone up. We can't, our cash flows aren't there. We got to renegotiate this loan. So we think there are going to be a lot of renegotiations, and it will halt a lot of activity. And I do think that it will get into the economic statistics. So I just want to make sure you understand, we do not believe this is a Lehman-like moment, but we do believe there are some banking issues out there. And certainly the bank indexes in the stock market if you look at them, you will find the regional banks have been disproportionately hit in here. The money center banks haven't been doing that well, but they're kind of steady state. So the market is making that distinction. So just a little bit more of what has happened here. During 2020, when we were going through COVID, there was a huge amount of stimulus, as you will all remember, and many banks had incredible inflows, deposits, and both Silvergate and Silicon Valley Bank were two of them. So here we are. Now, what are they going to do? Well, Silvergate really didn't make loans. So it bought securities, liquid but long-term oriented securities, fixed income. And you'll see that Silicon Valley Bank did that as well. Silicon Valley Bank, which went under, took all that money, and if I remember, it was in the $70 to $90 billion range, and put it into these long-term instruments to earn a higher yield than in the money markets. At that time, money markets were paying maybe 0.5%, and they got 1.6% on average on that money. Now, the assumption they were making is that interest rates were not going to go anywhere anytime soon. And of course, that has proven to be wrong. Interest rates, as I've mentioned on this webinar many times, have gone up, I think it's 20-fold in less than a year's time. That has never happened before. And I hearken back to 1981, when Volcker was trying to squeeze inflation out of the system. He took interest rates up twofold, from 10% to 20%. True, a high level. But the shock, already people had gotten used to interest rates going up, so they were preparing for it. So the shock from going from 10 to 20, there was some shock value, but nothing like we're seeing now. And here are some of the ramifications. Now, many people, in comparing to 1981, they say, well, the yield curve is the same as it was back then. And my answer to that is an inverted yield curve of 100 basis points when long-term treasury yields are 4% or less. That's like a 25% inversion if you're trying to measure it, get a sense of sizing it relative to 1981. So 100 basis points over 4%, 1 over 4, 25%. If you go back to 1981, that 100 basis point inversion was against 15% interest rates. So that's more like 6 to 7%. So I would submit that this is sending 4 times the signal that inverted yield curve sent in the early 80s. And I think we're beginning to see some of the ramifications. What the problem for Silicon Valley Bank, which was considered a very fine bank, had an amazing reputation. Yes, it had customer concentration. And yes, it probably started making bad decisions, just helping GPs, general partners of venture capital funds, fund this, that, and the other without really studying, thinking, and assuming that venture would go on forever. We haven't had down rounds in quite a while, and it would go on forever. Well, that also was an incorrect assumption. So what happened? Deposits left, and it was forced to sell securities, which it was holding at a loss. And these are held to maturity securities, which those losses don't really show up unless they're realized. And so they had no choice but to turn to both all of the securities that were available for sale. They sold those at a loss, I think a $1.8 billion loss. They tried to do an offering to fill that hole, an equity offering of $2 billion, and the market absolutely rejected it. And that's when we knew, oh my gosh, they're going to be forced into selling these held to maturity securities because they're upside down. In order to attract deposits, they would have to increase interest rates dramatically. And even then, because they're so focused on the venture capital community, which is actually calling capital, those deposits were being drawn down because these companies haven't been able to do new rounds, and many lose money. And so they were forced to take down deposits. So it was in a very bad way. I think the mark-to-market losses were $15 billion, and its equity position was only $12 billion. So effectively, it was insolvent, having to recognize those losses. And so here we are. So again, I'm just explaining what happened. There are some other regional banks, we think, in a similar position. Maybe they've catered a little bit too much to the VC community. Maybe they are in the middle of negotiating on non-commercial loans, office buildings, and are having to mark those down as well, or the market is seeing that could be the case. So just wanted to explain that a bit. Now, the other thing that I've been really focused on, and it is an esoteric concept or topic, I should say, and I have mentioned it before, but it is at this time that it's very important. If money growth on a year-over-year basis is negative, there is an equation out there in economics called MV equals PQ. Money times velocity equals price times volume. Now, if money and price times volume is GDP, nominal GDP. So if money is going down, what is keeping nominal GDP from going down? It is an acceleration in the turnover of money. And that usually happens in risk-on situations where confidence is very high. And it sometimes happens out of necessity, which has happened very recently. Now, the concern here is that this banking crisis, I would call it a mini crisis, is because of muscle memory associated with the crisis in 08-09, is going to cause individuals and corporations to slow things down a bit, not take that extra risk, make sure they have a big enough capital cushion. And then there's another thing that might be causing that. The student loan moratorium, it looks like it will end in June. So in July or August, the consumers that have been enjoying that moratorium will have to turn around and start repaying those loans. In preparation for that, they might be slowing down purchases. So that this idea, money going down, if velocity also goes down, so the rate at which money turns over because people are becoming more cautious, want to build their cash cushions, if that happens, then we have a severe recession. That I've been saying recently, how could we have a severe recession if housing is already down 40% by some measures? In fact, it's interesting to note that existing home sales are at 4 million units at an annual rate as of the last reading. When I started in the business, 1977, I was in college. Existing home sales were 5 million back then, and the population's much larger today. So that's really saying something about where housing is. Autos are also down, not as much as they were. But if we get this cautious behavior, they will come down. And consumption generally will come down. And that's the only way we can have a severe recession, because we've been through rolling recessions in the last year. So just wanted to explain that. And I hope that gets more discussion at the Fed as well. It's important. So I'm on to economic indicators and market indicators. I won't spend a lot of time because, frankly, what's happening in the banking system right now is changing everything from my point of view, from our point of view, and is going to make the Fed think twice about what's going on. And that's a good thing. What I will say is we do believe in the last 2 months that the Fed has been influenced by economic indicators that have looked unbelievably strong. Now, retail sales up 3% in January. Month to month, that's like a 36% annualized rate. With department stores, I think department stores were up 17% month to month. So that's like 200%. Does anybody believe that? No. Those are seasonal factors gone awry, actually. The seasonal adjustment factors expect a cold winter, especially in the Northeast. They didn't get it. So the adjustments that they're making to adjust out the impact of winter are causing crazy statistics. And the Fed has been paying attention to them, clearly, because of how Chairman Powell was talking on Tuesday and Wednesday of this week. He sounded very hawkish. And so the employment report today, likewise, again, still a warm winter, another strong employment report by some measures. By other measures, the Fed got what it wanted to see. Average hourly earnings up only 0.2%, so 2.5% at an annualized rate. Those are wages. So the wage, the inflation that we have seen is not feeding into wages. We're not seeing that cost push inflation that was associated with the 70s. And the other thing we saw in this report was a decline in the work week, which means the headline report isn't as strong as it looked. So that's all I'll say on the economic indicators. On the market indicators, well, it is interesting to watch just over the last month what has happened in the equity market. So the S&P 500, this is a month to as of today. The S&P down 6%. And the worst performing sectors, again, the market is beginning to recognize everything I've just talked about in the banking sector. Real estate and financial services both down about 10%. The best performing, consumer staples, down 3%. Industrials, technology, all of them down 3%. So in the fixed income market, we started the month of February at about 3.5% on the long-term bond yield. It went up to 4.1% very recently. Now, as of today, we're down to 3.7%. So a slight increase over the month, despite the Fed sounding very hawkish. I always look to see if there's trouble brewing out there more broadly in something called the high yield spread. So the spread between junk bond yields and treasury yields. So that started the month of February at 4.5%. So add that to the 3.5 and you're at 8% for junk bond yields. Today, that is at 8.6%. So the spread is at 4.9%. Now, just to give you a frame of reference, in last October, before bond yields peaked, that number, the 4.9, was as high as 6.1. And we were beginning to get worried. In the coronavirus, the depths, it was close to 10. 10 percentage points. And during 08-09, it was 20 percentage points. So 4.9 is not in crisis territory. It's kind of at the midpoint, I would say, of where we've been over the last maybe 10 to 15 years. So, but we'll watch that carefully. Commodity prices and other prices. Well, let me give you. I've got some of them here. If you look at the commodity prices from lumber to gold, you'll see that they're down, in the case of lumber, from its peak 79%, gold is down 11%. If you look year over year, most prices are down, and down significantly for many of them, on a year-over-year basis. So lumber's down 73%. So this is year over year, which we'll get into the year-over-year inflation indicators with time. You've got DRAM, which is semiconductors, down 56. You've got oil down 30. You've got silver down 22. Corn, even corn, down 16%. Copper's down 11%. Gold is down 8% on a year-over-year basis. And what I like to remind people is, I think gold is one of the best inflation gauges, and it peaked way back in August of 2020, nearly $2,100. It's around $1,850 now, and it's been really in a trading range, and that's where we want it to be. We want price stability. So even lithium prices, I know a lot of people are talking about shortages of lithium because of the boom in electric vehicles. They've dropped 10% in the last 2 months. And Bitcoin in really less than a month has dropped 20% from its peak in February at 25,000 to a little bit below 20,000 now. Now, I want to end this call on cryptocurrencies because I was on CNBC with Brian Sullivan on his new show. I think it's called Last Call on CNBC yesterday. And Silicon Valley Bank was breaking. And, I wasn't even supposed to be talking about that. I was supposed to be talking about innovation. But I think Brian brought the topic down to, see, crypto dominoes still falling, hearkening back to Luna Terra last year and FTX and 3AC and Celsius and all of the implosions. And what I said to him is, if you think about it, first of all, just think about crypto. The Bitcoin blockchain and Ethereum, those two blockchains have not skipped a beat. There have been no transactions interrupted. The smart contracts, which are rules-based, when there's a margin call, a stock goes down or something drops in value, there's an automatic margin call. It just happens automatically in this over-collateralized system. I think what we're seeing today is in some of these banks under collateralization. But in both cases, what do we have going on? These are centralized entities, and they're not transparent. Certainly when it came to FTX, not at all transparent. Centralized, opaque, completely opaque. The banks have to do more disclosure, so they're not as opaque. You could see that they were upside down in terms of interest rates, having to pay up for deposits, but earning a very low yield to which they committed at a bad time when interest rates were very low, thinking they were being smart. So this is nothing to do with crypto. In fact, Silicon Valley Bank, I don't think you're going to see a mention of crypto at all there. So it has nothing to do with crypto, but it does have something to do with what happens during banking crisis usually. These banks are upside down. They start losing deposits. In the case of Silvergate and Silicon Valley Bank, there's a run on the bank. When you get Peter Thiel and other famous investors and well-respected investors saying, get your money out of there, they're going to take the money and run. And so this is nothing to do with crypto. This has everything to do with Fed policy, we believe, taking interest rates up so dramatically, the most rapid rate in history, and taking money growth down from 27% 2 years ago to -3. So that's a 30 percentage point swing that has never happened. We've gone back to the Great Depression to see if that was the case back then as well. It wasn't. And so I think we're going to see more ramifications, but each one of these is a reminder to the Fed. And I think the Fed's rhetoric is going to change pretty dramatically during the next 3 to 6 months. So hopefully the market began to see this and expect it, meaning the other side of the interest rate move to the upside. The market in the equity market in January began to anticipate that the Fed was going to lower the rate at which it was increasing rates, which was true. It did, 25 basis points. And this crisis, I think, was caused by hawkish talk from Chairman Powell this week, suggesting, wait a minute, are we going back to up 50 basis points? And I think that's caused basically a run in some banks, but very specific banks with customer concentration or loan concentration with a particular group of entities. So it seems like crypto has been blamed for everything since last year, but actually that what has happened with the Bitcoin and Ethereum blockchains is they serve as proof of concept. They have not stopped. Transactions that were supposed to take place are taking place seamlessly. And, the health of the network is still very strong. Short-term signals, on-chain signals might have turned a bit negative because crypto is not immune from liquidity pressures generally in the traditional world. But this idea of decentralized and transparent, which we believe is going to support digital wallets, it has just gotten more of a proof of concept. More centralized entities are going under. They don't skip a beat. And we do believe that the financial system is going to evolve more towards digital wallets, which are involved in decentralized and transparent networks that are going to maintain their health. The transparency is the reason they are remaining healthy. So with that thought, I will leave you. We will have our monthly market update this week, Thursday. It will go on our ARK-Fund site, FUNDS, on Thursday, late afternoon, after the market closes, I believe. And whereas this kind of presentation is on our ARK-invest.com site. So with that, I will look forward to updating you in the next month. I think we'll see a lot of resolution in terms of Fed rhetoric shifting towards we've probably done enough. So looking forward to that. And I hope you have a lovely weekend.